FHN, right? FHN, which is First Horizon Corporation. It's a pretty decent sized bank. Has been, in my opinion, had a big sell off not too long ago. And then again, it wasn't really related to kind of like what happens to Silicon Valley Bank, where they had kind of like a panic and big and institutions like withdrew their money from it, causing the bank to basically collapse. In this case, it's basically an acquisition that fell through um, between TD Bank and which is a Canadian bank, who was going to acquire First Horizon Corporation. So here you can kind of see basically in February the stock was like $24, almost 24.50. And after the whole acquisition stuff happened and the acquisitions fell through with TD Bank, the stock has pretty much been hammered, where it's trading like near COVID levels. So basically, First Horizon Bank has a market cap of $6 billion approximately. So it's not a small bank. It's a pretty decent sized bank. Has a beta of 0.96, which means it's supposed to be less volatile than the S&P 500. PE ratio of 5.80. So it's selling for, it has a value PE ratio, basically, like a value stock. And then it even has a dividend, 5.44%. So what they do is basically the company operates through three segments: regional banking, specialty banking, and corporate. It offers basically banking services for consumers, businesses, financial institutions, and other governments. A lot of its portfolio of First Horizon Corporation's portfolio is real estate related and basically just loans. So it's heavy in commercial real estate market in one example. So this is basically kind of what happened recently. And interesting enough, it kind of happened during the time the Silicon Valley Bank went bankrupt, which could have added to like the negative view of this company, right? Or the fear that, because well, for where it's selling, unless someone believes that this bank is going to like go bust, it's under book value. For things to be under book value, they could either be really risky or they could be selling for a discount. So basically, on February 28th, 2022, the bank, and which is TD, and First Horizon Corporation announced a definitive agreement for the bank, which is TD, to acquire First Horizon in an all-cash transaction valued at $13.4 billion. So TD Bank was willing to pay $13.4 billion for FHN, which is the bank I'm currently talking about, which that is basically $25 a share. So TD Bank, big bank, was going to pay $13 billion, which is $25 a share for FHN. But the deal fell through, which caused more of a dislike. The market basically seems to really dislike this bank right now, or there seems to be a lot of fear in it. So TD pulls $13.4 billion dollars from Horizon's purchase, leaves U.S. Bank in limbo. I read somewhere that part of, if the acquisition deal didn't go through, TD Bank would have to pay First Horizon $500 million kind of as a contingency if the deal didn't go through. So FHN received $500 million off of the fact that the deal didn't go through. However, the market reacted very differently. So yeah, basically May 4th, 2023, which is again around the time where the whole fear in the banking system was, or I mean, kind of still is, but That's when all these banks were going bankrupt, like First Republic, New York Signature, Silicon Valley, and so forth. That's when TD basically, I believe it was because regulators or something pulls out of the deal, adding more fear to this specific company or stock in the market, right? Which is you can see basically is it's been pretty beaten down. So on another note here, which I'll switch over, let's see how this company is doing actually financially, right? So let's see. It is not like risk free, but it is not in bad condition either from what I'm seeing. And I've gone through looking at this company. So they've been investing money, net cash used providing by investing activities. So as of these filings are from June 2023 of this June 2023. So they've invested I believe these are in millions, a lot of money recently into the bank, right? See over here, net increase, decrease in cash. They had a decrease in cash, nothing crazy. From so $124 million decrease in cash. Cash and cash equivalents. At the end of the period, they have $1,419,000,000 in cash. Okay, let's see what's going on here. So yeah, 6 months ended June 30, dollars in millions, except per share data. Shares are in thousands. So interest on fees and loans, they're making more interest on their loans, as you can see here. That's $1,683,000,000 compared to last year, same quarter, 936 million. Total interest income has grown, which that's a good thing, right? Banks make money off of making loans. They charge interest on these loans. They generate revenue like that. So here, total interest income, $1,934,000,000, which is up pretty decent amount from last year, almost 100% increase in difference. Net interest income, again, an increase here, $1,318,000,000 compared to last year, so increase there. And so they're making good, they're making interest off of their loans, which is always good for a bank, right? Gain loss on bank-owned life insurance. So banks own life insurance. I was like pointing that stuff out. Net increase, decrease in derivatives. Skip that one. But that's basically they've decreased the amount of derivatives they own. Sometimes banks purchase derivatives, which are like almost a hedge against interest rates. So if they're doing it in the right way, where they're betting against interest rates going up through a derivative, they're protecting themselves from increases in interest rates, which tend to be bad for banks. Here's one pattern I noticed in all of the banks I've seen. They have paper losses on debt securities, such as government agency issued bonds, government agency issued CMO, I forget what that stands for, commercial, some mortgage obligation, I believe, other US government agencies and state and municipalities. So even city and state debt securities have lost, they're losing their value, right? And this is what's going on in all of the banks. So they're holding on to some decent paper losses. In this case, you can see here, as of June 30, 2023, FHN has $1,264 $1,000,000 in paper losses from debt securities, which has led for other banks to get in trouble. So here that kind of creates or brings in a risk. Could this factor in why this company is selling for what it is as well? But these paper losses only matter if depositors withdraw their money, putting a bank into stress where they would have to liquidate, take the losses they're holding on to. So they become realized losses to pay the depositors that are withdrawing their money. So that's where this would create a big risk. However, if the debt securities are lived or held until maturity, they don't take this loss, if that makes any sense. Net income, the net income for this bank has increased. Recent $585 million. That's good as compared to last year, $374 million. So net income has increased. Basic earnings per common share increased as well. The bank is, in my opinion, seems great, except for it's holding on to paper losses from debt securities, which all banks are currently, and that creates a risk there. Because if there were to be a bank run, the bank would have to liquidate and take those losses if they don't have the available funds to meet their obligations of the depositors that are exiting and withdrawing their money from the bank. So I honestly I like what I'm seeing with this bank, as potential risk reward. The only concern is interest rates are still going up, and that is not great for banks, because that means it costs them now more as well to borrow, and they, like everyone else, pass that on to the consumers or the users. So let's see here. But yeah, that's what I've found interesting and noticed from all, basically any corporation or any bank or any business that has invested in debt securities, which include real estate, government bonds, municipality and state debt securities, are holding on to losses because interest rates have gone up. So those bonds are now selling at a discount. So see here, this is mortgage-backed securities, unrealized losses being held, government agency mortgage-backed securities, which these are, they're risk-free. Basically, don't want to say risk-free. Only Ginnie Mae is risk-free. So let me see. Yeah, basically it's just government agency, U.S. government agencies tend to be more on the less riskier side of things, right? But still they're holding on to paper losses. But I did see somewhere that I believe is here. Let me see. So consistent with FHN's review of related securities, there were no credit-related write-downs of air for AFS debt securities acquired for sale. I believe that's what that means during the reported period. Additionally, for AFS debt securities with unrealized losses, which is kind of some of the investment.